Yes, the fourth stage is now coming up, and we're going to get through it with stamina and discipline. First, let's talk about the period of decline. Can you see the screen? The period of decline is when the growth rate stabilizes or decreases. When a product enters the saturation stage of the market and fails to adapt to future technologies or trend changes, it directly leads to this period of decline. Current priorities include cost reduction, business restructuring, exploring new opportunities, and implementing turnaround strategies. Some people may have worked hard during the maturity stage but didn't make it this far. However, once it's clear that the business has entered the decline stage, turning things around becomes one of the most difficult tasks. So while you shouldn't lose hope, it's a stage where the possibility of a turnaround is quite difficult.
It starts. The reason is
These large companies with numerous employees and facilities require significant time to relocate operations. Such situations are common. Here, what we need to watch out for is that this indicator is also the operating cash flow.
It's a sigh. Operating activities.
If the cash flow from operating activities decreases rapidly and turns negative, be cautious from that point onward. So you have to let go of the last bit of hope you were holding on to. Until the end, you might still think, is this company really going to go bankrupt? Is it possible for this company to fail? I'm not saying that Intel is an example right now, but it's the type of company that could end up like that. One of the major warning signs is when operating cash flow turns negative. It's just as important for a company's operating activities to turn positive in the early stages of growth.
It's a very important signal.
In technical analysis, signals captured at the beginning and middle stages, like those caught early in growth or entering with special initial characteristics, directly lead to trading activity. Whether the cash flow turns into a plus or a minus, that's the point here. For companies that have always been in the red, it doesn't matter. Growth companies also start in the red, but when they turn profitable and then return to losses, it's like the moment before a yellow light turns red. That's how you should view it. You must be very careful. Valuation indicators are unreliable at this stage. Everything appears cheap, but prices continue to drop. You may buy because it seems undervalued, only for the price to fall further. This cycle repeats with the price constantly looking undervalued but continuing to decline. Because these kinds of patterns can keep repeating. Basically, if you want to enter the market, I think the right strategy for beginners, like our elementary and middle school students, is not to touch it at all, even if the valuation looks cheap.
That's what I think. Intel.
Intel's stock price has significantly dropped from hundreds of dollars to around $70 to $80, and now it's fallen further to $20, where it remains at the bottom.
It's a range here.
If you look,
The growth rate is minus.
the fact that the export growth rate is negative is really
a shocking result.
If you look at it as a performance indicator, that's correct. I'll move this over to the site and check the Intel together as well. First, if you look here, if you do it like this, the growth rate shows up as 0 like this. But with cash flow, it's still being generated, so there's no high risk or financial risk. In other words, this kind of growth is almost non-existent in this situation. When I said it's becoming mature, I meant it's becoming like this, a triangle shape. But if you look at Intel now, it's drawn like this. It's a triangle shape.
But the top.
It's a triangle without a top. In this case, it's a shape with a relatively high risk. You have to look at it like this. This type can usually be seen in startup companies. In startups, their cash flow may be low, but their growth potential tends to stand out like this.
So first of all,
for companies whose growth has ended and are entering maturity, you can see that they have almost no growth potential and appear in this kind of pattern. Even if you look at the growth indicators at the bottom, sales dropped by 14% in 2023, and in 2024 it's minus 2%. So this was already expected before.
If you look at it this way,
first of all, it's best not to touch it. But the main point is that the market moves whenever Intel announces a policy or the government announces a policy. So, some people think that they have to react to every piece of news about government policy, but I think it's difficult to develop that level of insight. Government policies can be short lived, and people often attribute stock price fluctuations to these policies, regardless of whether prices rise or fall. Such explanations are merely news stories. So, I think relying on that to make trading decisions will actually lead to more noise. First of all, the best thing is not to touch it when your selling amount is in the minus. In 2025, minus 4%, in 2026, 5%, and in 2027, 7%. It still won't be easy to recover for the next 2 or 3 years. Even when considering the earnings per share, it shifts from a deficit to a surplus, with the turnaround occurring 2 years later. However, this is likely being discussed under a best case scenario. Currently, artificial intelligence and semiconductor technologies are advancing rapidly,
These parts
seem to be becoming a big issue. Next, if you take a look at the items in the Sonic calculation, you can see what I just mentioned a bit more clearly. If you look here, now I'll show you the research and development expenses as a whole, all at once. Looking at the 2022 research and development expenses, it's evident that they haven't increased significantly, yet Intel has already fallen into a deficit. After entering the deficit, if you look at this company, you'll see that capital expenditures have increased again recently. This is because they made capital investments, so their facilities have expanded, but while their facilities increased, their operating and research and development expenses have stayed about the same. However, their sales revenue is actually decreasing during this period. The lack of market response indicates that the products are not resonating with consumers.
So the facilities.
Investments, production, and R&D increased, but sales decreased. In simple terms, it failed to sell in the market. So, since they're holding on to the unsold inventory as it is, you could say that their fixed costs are quite high. So, I think those parts are probably quite challenging for Intel. Honestly, companies like Qualcomm and others are advancing their technology so quickly that I can't explain the parts I don't know about until I follow up and catch up with them. Currently, Lee, when I only looked at the situation in the market, still as a product, there is still no response yet. If that changes to happen, it should at least result in a certain type of asset or a growth rate above a certain sales growth rate. The indicator to check this is actually the return on tangible assets, so I will go over this once more when we talk about investment indicators. It's about the ratio of how much sales you generate with a single unit of tangible asset. So you divide the sales by the tangible assets, and this ratio is usually consistent for most industries. But if this ratio suddenly drops, it means that a lot of investment has been made in tangible assets, but sales haven't increased right away. However, if sales from tangible assets increase, this ratio, which temporarily dropped, should return to its original state. As it recovers, sales and profit growth should appear. If recovery doesn't happen, like with Intel currently, it means the investment isn't leading to increased sales. Calculating the tangible asset turnover ratio shows that it has dropped and hasn't recovered as much as it did previously. In cases like this, we can interpret it as a sign that the market isn't responding. In this case, be a little careful. You have to watch out for that. Next, in the second half, I want to check with you about the business activity funds in cash, which are connected. To see the initial investment in Seongjangju or Sedeok, it's best to examine it by period. It changes quickly on a quarterly basis, so I check it by quarter.
If you look 2025,
Goes up to March. Looking at the company's cash flow from business activities over the past 10 years from 2015 onward, there has never been a case where it was negative. The cash flow from business activities has continued to be positive, investment has consistently been in the minus, and the cash flow from financing activities has continued with a good trend in the minus.
and at one point
The cash flow from business activities once dropped by about 1 billion in a quarter, then suddenly turned negative, then went back to positive, and then in March it increased again quite a bit.
it decreased here.
Cash flow from business activities has increased compared to last year. This increase remains positive. If you look here compared to the past, compared to these figures in the past, if you look at it over the years, it used to be around 35 billion won, but now it's decreased to about 10 billion won.
so this
If these parts are converted to the unit of atmosphere, Intel will really be in a difficult situation. If there is no cash in the operating cash flow, they must continue to change through financial activities like borrowing. However, they haven't reached that stage yet. And right now, I think many of you are also Intel shareholders, so I'm being very cautious. It's just my initial impression sharing things like this.
No, I mean on the financial statements.
When I looked at it by stage of growth and by stage of the life cycle, it was already in decline. The company must swiftly invest in emerging tech, trends, and strategic moves like M&A to capitalize on turnaround opportunities. In the long run, the primary drivers may exhibit a minor upward trend. However, intense competition could limit their movement, and the strength of valuation might restrict the extent of their shift. I think there might be some limitations to raising the stock price just based on the intrinsic value of the company.
In my opinion, there are people who really like dividend stocks. For those who like dividend stocks, I think it would be good to compare them with something like Intel right now. Anyway, in order to keep growing dividends and be able to receive them, the company shouldn't reduce its profits even if they're small. That's why they need to maintain cash flow and keep it healthy so they can provide steady and strong dividends. It would be beneficial for dividend stock enthusiasts to examine and compare their preferred dividend stocks using Intel as a reference. For example, with international business machines Cisco or Oracle, you might want to check if these companies are in decline like Intel or if they're still maintaining healthy cash flow and continuing to generate profits. I think it would be good to check that at least once.
It's also about Intel's dividend payout ratio.
Can you see the screen?
So we're showing you all the dividend attractiveness scores as a perfect 5-point scale, and you can find this by searching for dividend in the category search. We're currently updating the dividend screen as well. So on the dividend side as well, we use a pentagon-shaped radar chart to show whether the company has ever cut dividends in the middle, how many years the dividends have increased, and we check all of these and score each category to show you. A company scoring 3 out of 5 is the minimum for dividend attractiveness. Companies scoring 4 or higher are considered good. And if you look below, we are providing you with 10 years worth of data. So you can see the dividend yield data, and if you look at the dividends per share, you can tell that they've been continuously decreasing since the financial crisis. So since the dividend is continuously decreasing right now, the reason for this decrease is that the earnings per share is going down, which is causing problems. The earnings per share should be increasing, but here the payout ratio is 185%, which means they're paying out much more than their earnings per share. So in this situation, it's not sustainable to keep paying dividends like this. That's basically what this means. When we talk about payout ratio minus, it means the payout ratio is negative because the earnings per share turned into a loss. Even though it's a loss, they still paid out $0.38 as dividends.
Right. So
The current dividend yield is now about 1.8%, amounting to $0.38.
but one.
If it's 1.8%, the dividend yield itself isn't that high.
But still, like this.
Since it's accumulated, of course, there's compound interest. So there's principal, and because of that, it's possible that it could keep decreasing by about 0.38 going forward. When investing in dividend stocks, it's crucial to select companies with increasing dividends. For the dividend to grow, the earnings per share must also increase. Otherwise, there's a limit. This factor affects the attractiveness of dividend stocks, which isn't always very high. If you look at other companies in this way and make some judgments, and if we have a separate episode on dividend stocks, I'll take the time to explain how to evaluate individual dividend stocks and how to choose investment points.
Please look forward to it. Then let's move on to the last stage, which is the system summary. Yes?
This is the final system summary. So companies that have entered the maturity stage, actually even Netflix has entered the maturity stage. So once they reach that point, isn't it true that Netflix can't really expand any further? Haven't almost all the people in the world already seen it? And even in this kind of subscription model, there was actually a brief limit to growth in sales. So isn't it true that Netflix is also finished? So there was definitely a time when the stock price dropped quite a lot. But then this company found another period of growth and started to rebound in this way. That's where we are now. So it's a situation where the company has recovered to at least a period of maturity and growth. So this company entered its second growth phase, but in the end, it had to find new growth opportunities. In the case of services like Netflix, they started to differentiate their subscription plans. So when you look at the ads, you might think, I'll just endure it. but the subscription fees became a bit burdensome, and that's why there were a lot of negative opinions. So, how much would that really be? And yet, unexpectedly, that side of the market grew significantly, and as they brought in a considerable amount of sales, Netflix was able to recover and become profitable again, which was a very important turning point. After that, as prices increased and other over the top companies struggled, Disney Plus and Apple Television, for example, emerged as unexpectedly strong competitors. In fact, Netflix's service became much stronger. As things continue to move in this direction, it seems like we're seeing more of a trend toward polarization. The sonic calculations can demonstrate these things, but when only considering the Netflix situation, that's the reality. If you look at the typical institutional status of a company, usually these kinds of mergers start to happen. To grow a lacking area, we can invest our available cash in that industry and integrate it to expand further. So, even in the case of Meta, although Meta started as Facebook, if they hadn't acquired Instagram, would they have survived? That's how precarious their situation really was. That's why M&A is a very important strategy for companies to grow and secure cash. And managing that cash is crucial. So if you look at new industries, you'll see that M&A happens very frequently. Doing M&A shouldn't be seen as something negative. It's about providing and securing a lot of cash, and that's how it works. Even in the case of companies like Adobe, we used a lot of our capital like this. The design department has already moved on significantly to using Figma.
Our company too.
We're using Figma too, but Adobe acquired Figma, and I heard they bought it for a huge amount of money. Personally, I think if Adobe hadn't acquired Figma, there was a chance that Adobe's era could have ended. That's how risky it was. But now, after the acquisition, a lot of artificial intelligence features have been added to both the artificial intelligence side and inside Figma. Recently, they're talking about generative artificial intelligence like the MCP feature, and they're integrating those kinds of things. If you use Figma, you can connect everything from design to coding to programming all in one place.
That's the direction it's heading. In the past,
Photoshop used to be just for drawing designs, but now with Figma, you can code, publish, and even edit code all in one place. That's why it's developing rapidly. If Adobe really hadn't bought it, Figma's value would be pretty low right now, unable to move forward. When I think about it, Figma went all the way to the peak of its growth, then almost to the end of its maturity, and now it's at a point where it can't decide whether to be reborn or not. Still, I think the only chance it has to be reborn is through an M&A. If they hadn't acted, they might have faced an even tougher situation. Anyway, that's one of the important points about why M&A is necessary. So whether these sales growth rates are accelerating again, these points are quite important, and whether business activity cash flow is growing even more, this part is crucial. For valuation indicators, price to sales ratio and BER, which compare with sales and profit, are a bit important. So Netflix also had its stock price adjusted quite a bit, but if you look at the recent Japanese stock price, it has risen quite a lot, right? It has gone up a lot, and if you look at it now, you can see that this growth is recovering again in this structure.
that's what's happening. Lastly,
I'll go back to the screen and let's take a look at Netflix together and wrap up today's class. Netflix is a subscription-based service. The buy signal for Netflix. There are a lot of trades with frequent short-term gains and losses. So the win rate is around 300%. It's a case with a lot of trades.
that's right.
It's a case. Even in cases like ours, if you look at the valuation in the past, this is a high valuation. It's a high valuation, and even though it's 930 trillion won, it's still a high valuation. At this time, if you look now, the company's value will reach a completely new level by the end of 2024, or it will be a point where it is completely upgraded. A stage exists where the valuation significantly increases due to the company's performance drastically improving and exhibiting growth. If you look before that, this stage rises like this, but when you look at the rising stage, it goes up very slowly, right? It goes up in line with the company's growth, but then the speed at which it jumps and rises next is much faster compared to the past. Even when the price was $900 at both times, it was considered undervalued earlier and overvalued later. This is because the company's value increased over time. So right now, the valuation is still a bit higher than the fair value, but according to the data, it's not in an overvalued state. If you look at the chart, you can see that it was sold here, once bought and then sold again. I think this was probably a sign of taking profits, but the signal may have been incorrect, causing it to get stopped out.
But then again,
When the buy signal is caught, fortunately, from then on, without much change, it steadily rises and the price goes up like this.
that's what happens.
If you look at the bottom of the company, the growth rate stands out at exactly 55 points. As long as this company still has 55 points, it means the growth rate is high, and it's a company that is at least in the mid-growth stage or higher. This is clearly shown here, and it's a case similar to Google. You can see that from the score. Usually cases that stand out like this are typical examples. And if you look at the bottom, it shows you various competitors. If you look here, you don't see anything like Walt Disney. The growth rate that Disney shows in this way means that Disney also needs to put in some effort to catch up. It's at a point similar to Apple, as I mentioned earlier. Fox is the same. Since this area is all empty right now, you can tell that this is a time when some kind of change is needed. If you look at the comparative analyses of these competitors, you'll see that there's a menu called Competitors at the top. We're also currently revising this section. So if you click on it later on, you'll be able to see all the competitors at a glance in a graph format for easy comparison.
so that you can easily compare them.
We made it all convenient for you.
That's what we did right now.
We're just analyzing the indicators here, similar sizes and indicators, but we're converting everything here into a pentagonal shape ourselves, and we can see the competitors at a glance so that you can compare them. Now that I think about it, I've already told you all the plans we're developing, the pre-launch version, the competitor comparison version, and the one we're working on right now. I'll continue working to provide you with the necessary data, enabling you to discover good companies and effectively compare and analyze using the information. If you look at the bottom, you'll see that in 2023, the sales growth rate was 6%, but in 2024, it increases to 15%. So if the sales growth rate is 15%, that's quite an improvement. This period, where the change occurs, is often reflected as the sales growth rate in the early stages of a turnaround, according to the discounted cash flow calculation. This phase is very important. The growth rate decreases from 14% to 12%, and then 10% in the following years. In 2026 and 2027, it decreases further before stabilizing. So I think Netflix will continue to find parts of other business models that need to be discovered within the over-the-top industry. Earnings per share was 64% last year, 28% this year, and projected to be 20% for the next 2 years. So now when the sales growth rate comes out to a certain level, the profit growth tends to be a bit higher. So just looking at the profit growth rate, I think we could see about 20 to 30% for about 3 years. Although the sales growth parts may slow down a bit starting next year, we can still see this as a case where growth recovers and becomes solid again, and that's exactly what we can call Netflix. So in the case of something like Netflix, you can also confirm that in the financial statements and in the financial statements in this cash flow calculation, if you look at the sales figures here, you can see that they grew well, but from this point, they actually start to slow down a bit, or the growth rate starts to drop from this point. 2,931, 3,133. In reality, the growth rate is around 6%, not 10%. A sales plateau in 2024 profits are expected to drop by 60 to 70%, signaling the phase we are entering. These growth rates are now presented as confirmed figures, but we had expectations and consensus about these numbers even before that. So if the sales growth rate jumps from 5 to 6% to 15% at that point, you can see that companies with strong financial health or those that are expected to rebound become very important investment targets. Next, if you look here, even in cases like business activities or cash flow, you can see that in situations like Netflix, there's more minus and then it turns to plus. At that time, actually, it's the best time to invest, either for the first time or in the early stages of growth. That was in 2020. Back then, when cash flow turned positive, that was the best moment. And then after that, the operating cash had already dropped by 2 billion, but starting from the fourth quarter of 2023, it began to rise again as the company recovered, and it continued to increase. These kinds of patterns are typical for companies that are recovering. If you all make use of these things, you can see on the financial statements chart that the business profit drops as growth slows, but then it rises again. This pattern, where things start to increase again, is a sign of a company recovering and growing again. You can see it like this. So for today's class, I hope you don't just look at the financial statements as a bunch of numbers, but instead notice how these different growth stages appear. Also, if you focus on certain indicators and investment points according to each growth stage, I think you'll find financial statements much more interesting and maybe even easier to understand.
Usually, when you look at the income statement, it can feel a bit boring and difficult to understand. But I think today's lecture was a great opportunity to look at the income statement in a much more interesting way. We often discuss that lengthy broadcasts lead to fewer clicks, urging us to finish quickly. However, today, we couldn't shorten the broadcast any further. There were so many interesting parts, and if possible, I think we might need to make a part 2. There are still some parts that feel a bit lacking. Since today's broadcast was a bit long, let me try to organize things a bit. First of all, what stands out in my memory from the introduction is that many Koreans showed a lot of interest in IonQ and its appearance.
That's what happened. So
When we talk about both computer companies, people think there are a lot of similar companies, but when we actually looked at the market share, we could clearly see that there's a big difference between companies like Kunton Computing and IonQ. If you're interested in companies like Naver, Jovi, or AVA, which are often mentioned as similar, take a closer look at them. Jovi Aviation's style differs from IonQ and is more similar to quantum computing. I recommend directly comparing them to see the differences for yourself. And I think the growth period is really interesting. So today, you gave us some tips on how to find the next NVIDIA, the next Palantir, or the next Uber stocks. Going forward, I think many of you watching this broadcast will become more interested in companies that are shifting from cash burning to cash generating. The growth period was interesting, but so was the maturity period. The reason is, when we compared Google and Apple, the companies seemed quite similar at first glance, but we could actually see the subtle differences between Google and Apple by looking at their numbers directly. Analyzing research and development expenses and working capital changes in relation to sales fluctuations enabled us to make better informed investment decisions. The fourth point I mentioned earlier is about those investing in dividend stocks. You chose them for stability, but we've learned that even those can be risky. Even if the growth rate drops slightly, you might think, I'm just investing for the dividends, so it's acceptable even without growth. But when you take a closer look, you realize that these stocks might not be as stable as you thought, and in fact, they could actually be quite risky. Those of you who are investing in dividend stocks should probably check whether your stocks are in the right sector at least once. Lastly, regarding Jido, as an example, in the case of Meta, as you mentioned earlier, they once borrowed money using bonds, and it seems like they're preparing to borrow again. Whether it's smart glasses or virtual reality, there are parts that people are looking forward to. But the question is whether a company like Meta can make another leap forward like Netflix did. And if they do, it should be clearly reflected in their numbers. If you agree with that perspective and are already investing in Meta, then if you follow up and keep an eye on it, you might gain more confidence and be able to invest in these kinds of stocks. So we've looked into this by breaking it down into several stages. Later on, if we increase the number of categories and look at them theoretically like we did today, and then actually take some examples and look at stocks in each category step by step, I think it will be even more interesting. Yes.
then next time, should we prepare just those examples like that?
Doing it once seems easier, in my opinion. Understood.
Then for the next meeting, I'll bring only real-life examples and we'll practice and learn one more time in a more practical way.
We'll do it as a practical exercise to also serve as a review.
And it will stick in your memory.
I think it will stick well in your mind. Today we recorded for about an hour and a half, but in my opinion, it would be better to edit it down to about half of that and upload it. You must be very tired, sir, so please take a good rest.
Next week.
I'll greet you again.
Understood. Representative, you also went through a lot. Thank you. Thank you.